You ever drive past one of those huge wind farms with the turbines spinning from miles, or a massive solar park glittering in the sun, and just think, who on earth pays for all that? I mean, we are talking about projects on a monumental scale. Well, let's dive right into this explainer and figure out how these gigantic energy projects actually get funded. First off, the numbers here are just mind-boggling. We're not talking about your average business loan. These are incredibly capital-intensive projects that can easily run into the multi-billions. And that immense cost, well, that's the central challenge, and it requires some seriously creative financial footwork. So yeah, that's the big question, right? The one we're going to unpack over the next few minutes. How do these companies and governments manage to pull together these colossal sums of money to get a project from a simple blueprint all the way to a functioning power plant? To get our heads around this, we first need to understand two totally different ways of thinking about financing. You've got the traditional way, most companies get loans on one hand, and on the other, you've got this method that's built from the ground up for one single massive idea. Okay, check this out, because the difference here is everything. With traditional corporate finance, if a company takes out a loan for, say, a new factory and then defaults, the bank can come after any of the company's assets. We're talking its headquarters, other factories, you name it. But with project finance, it's a completely different kind of bet. The lenders are only looking at that one single project. If it fails, they can only claim what's left of that project. That's it. This distinction is absolutely crucial. So let's get into the nitty-gritty of this really clever solution. Because project finance isn't just about getting a loan. It's a whole financial architecture designed to make these huge, risky projects actually possible. At its heart, what project finance really means is that the project has to stand on its own 2 feet, financially speaking. The lenders aren't really looking at the parent company's overall balance sheet. Nope, they are laser-focused on the project's future cash flow. The only question that matters is, will this wind farm generate enough cash from selling electricity to pay back its own debt? So how do you do that? How do you isolate a project so it stands alone? Well, you create something called a special purpose vehicle, or an SPV. Just think of it like a brand new company that's created for one and only one reason, to build and run this one specific power plant. This legal separation is the absolute key to walling off all the financial risk. And this lays out the process perfectly. The companies that want to build the project, we call them the sponsors, they start by creating this new SPV. Then, and this is key, the SPV is the one that goes out and gets the loans. The SPV is the one that signs all the contracts. And eventually, the SPV is the one that collects all the revenue from the project. It's like a self-contained financial ecosystem. This whole structure makes a critical feature possible called non-recourse finance. It sounds a little technical, but the idea is simple. Non-recourse just means that if the project goes completely belly up, the lenders can seize the project's assets, the power plant itself. But that is it. They have no recourse, no legal path to go after the main businesses of the sponsors. And that is the whole point. What this does is create a financial firewall. It means a massive energy company can take a swing at a high-risk, multi-billion-dollar project without, betting the entire farm. If that one project fails, sure, it's a big loss, but it's not going to sink the entire corporation. But, okay, creating that firewall is just step one. Managing all the risk inside that firewall, that's where things get really complex. A successful project finance deal is kind of like conducting a massive orchestra with a whole cast of different players who all need to be perfectly in sync. And just look at all the players you have to keep happy. You've got the sponsors who had the big idea, the lenders putting up the cash, the contractors actually building the thing, suppliers, government regulators, and, this one's really important, the off-takers. Those are the customers who sign long-term contracts promising to buy the energy. The art of the deal is making sure every single one of them is on board. Which naturally leads you to ask, with all these moving parts and billions of dollars on the line, how in the world do you keep the whole thing from falling apart? How do you actually manage all that risk? Well, the answer is actually pretty genius. You meticulously identify every possible risk, and then you assign it to the party that is best equipped to handle it. So, worried the tech won't work? You make the construction company sign a fixed-price contract, putting that risk on them. Worried about energy prices crashing? You get the customer, the off-taker, to sign a long-term power purchase agreement, a PPA, that locks in a price for 20 years. Every risk has a specific tool to manage it. This quote really just sums it all up perfectly. The entire point of this complicated dance is to distribute the risks, to spread them out among everyone involved, so that no single player gets totally wiped out if something goes wrong. Okay, so we have this powerful, well-established financial model, but right now it's going through a major shift. The world's priorities are changing, and that is having a huge impact on which energy projects actually get funded. If you look back, the main question was almost always just what's the financial return? And that calculus often favored traditional fossil fuel projects. But today, a whole new set of criteria is moving to the front of the line: environmental, social, and governance, or ESG. Investors are asking totally different questions now, and it's fundamentally changing where the money flows. And here's the bottom line: ESG is not some nice to have add on anymore. It's become a core, hard nosed driver of financial decision making. Projects that are seen as good for the environment and society are simply finding it easier and cheaper to get the funding they need. This huge shift has sparked a ton of financial innovation. We're seeing the explosion of green bonds, which are basically loans that can only be used for eco-friendly projects. You have yieldcos, which bundle up operating renewable assets to create stable dividends for investors. And now we're even seeing things like crowdfunding and tokenization, which are wild new ways for regular people to own a tiny digital slice of a solar farm. These are all new tools for a new era. And no matter what kind of project it is, green or traditional, the basic recipe often looks something like this. The sponsors will put in about 20 to 40% of the total cost out of their own pockets. That's the equity. But the rest, the huge majority, 60 to 80%, that's all borrowed money. That's debt. And this heavy reliance on borrowing is exactly why that whole risk management structure we talked about is so incredibly important. Which brings us to one final big thought to leave you with. We've seen how these incredibly sophisticated financial tools have been engineered to build our energy world. But now, as we face the absolutely monumental task of transitioning our entire global energy system, the question is, will these tools, even with all the new green innovations, be enough to actually power our future?